Good afternoon, ladies and gentlemen, and members of the press. I welcome you to the Central Bank of Nigeria today. The Monetary Policy Committee met on the 22nd and the 23rd of July 2019 in an environment of subdued global growth and fragile domestic economic recovery. The committee reviewed developments in the global and domestic macroeconomy. It noted that the global environment is overwhelmed with vulnerabilities and financial fragilities. Inflation in the advanced economies trending downwards and significantly below the long-run objective, necessitating the adoption of accommodative monetary policy. The global economy is poised to see another round of loose monetary policy. All 11 members in attendance were at this meeting. The global economic development. Global output growth remained weak, with persistent headwinds expected to continue for the rest of the year. Key amongst these headwinds is the rising trade tensions, particularly between the United States and its key trading partners in Europe, Canada, China, and India, rising debt levels in some advanced economies and emerging markets and developing economies, as well as growing political uncertainties across several regions. Consequently, the International Monetary Fund downgraded its 2019 global growth forecast from 3.6% to 3.3%. Price developments across the major advanced economies remain muted alongside softening output growth. In the emerging market and developing economies, however, inflationary developments were mixed in response to challenging macroeconomic conditions. The committee noted that the return to monetary policy accommodation by the advanced economies could see a new wave of capital flows to the emerging markets and developing economies as investors continue to search for higher yields. The domestic economic development. Available data from the National Bureau of Statistics (NBS) showed that real gross domestic product grew by 2.01% in the first quarter of 2019, driven by the non-oil sector, compared to 2.38 and 1.89% in the preceding and corresponding quarters of 2018 respectively. The committee noted the continued but moderate expansion in the economy, as indicated by the manufacturing and non-manufacturing purchasing managers indices, which grew from 27th and the 27th and the 26th consecutive months in June 2019. The indices stood at 57.4 and 58.6 in index points, respectively, in June 2019. Staff forecasts indicated 2.11, 2.39, and 2.56% growth in GDP during the second, the third, and the fourth quarter of 2019, respectively, expected to be driven largely by the non-oil sector. The committee, however, noted that the downside risks to these projections to include low credit to the private sector, high unemployment, delayed intervention of fiscal policy, as well as low revenue and fiscal buffers, amongst others. The continued intervention by the bank in the real sector is, however, expected to partly ameliorate the downside risks only in the short run, while sound fiscal policy is expected to drive growth in the medium to the long run. Committee observed that broad money supply M3 grew by 4.97% in June 2019 from the level at the end of December 2018 at an annualized rate of 9.95%. It also It was also below the indicative benchmark of 16.08% for 2019. The growth in M3 was largely driven by the increase in net domestic credit (NDC), which grew by 17.26% in June 2019 from the level at the end of December 2018. The growth in the net domestic credit was accounted for by the significant increase in credit to government, which grew by 55.8%, while credit to the private sector grew by 9% in June 2019. The committee, however, noted the constrained growth in the monetary aggregates as an indication of weak financial intermediation in the banking system and called on the management of the CBN to sustain the various initiatives of the bank to improve lending to the private sector in Nigeria. The committee welcomed the moderation in headline inflation year-on-year to 11.22% in June 2019 from 11.4% in May 2019. This was attributed to the decline in the food and core components to 13.56 and 8.80% in June 2019 from 13.7 and 9.03% in May 2019 respectively. It noted the development has been partly due to the CBN's support to the agricultural sector and the prevailing stability in the Nigerian foreign exchange market. The MPC further noted that although inflation moderated in June 2019, the continued pressure on prices continued to be associated with structural factors such as the high cost of electricity, transport and production inputs. The MPC, however, expects that with the commencement of the harvest season, food prices will taper further downwards. It thus, however, advised that the security challenges in some parts of the country should be addressed urgently to increase agricultural produce in order to sustain the downward trend in inflation. The MPC thus reiterated its commitment to ensure the maintenance of price stability. The net liquidity position and interest rates in the economy reflected the impact of liquidity injections and the bank's liquidity management operations associated with fiscal federalism, transformation of maturing CBN bills, open market operations, auctions and foreign exchange interventions. Accordingly, the monthly weighted average interbank call and open buyback OBB rates oscillated around the MPR corridor, increasing to 8.38% and 8.71% in June 2019 from 5.14% and 8.34% in May 2019 respectively. Committee noted with concern the continued bearish trend in the equities segment of the capital market in spite of the sustained capital inflow to the economy, reflecting continued portfolio reallocation from equities to fixed income securities. Consequently, the all-share index declined by 9.11% to 28,566.79 index points on July 12, 2019, from 31,430.50 index points at the end of December 2018. Market capitalization, however, grew by 18.77% to 13.92 trillion on July 12, 2019, from 11.72 trillion at the end of December 2018. This was due largely to the additional listing of new firms during the review period. The committee welcomed the continued stability in the foreign exchange market and the steady accretion to external reserves, which stood at $44.88 billion as of July 19, 2019, 0.38% increase from $44.71 billion at the end of June 2019. The MPC also noted the steady moderation in non-performing loans ratio of the banking industry to 9.36% in June from 10.95% in May of 2019. While this remained above the prudential benchmark of 5%, its continuing moderation indicates the improved resilience of the banking system. Committee thus emphasized its resolve to further drive down the non-performing loans ratio in the industry so as to strengthen the strategic health of banks in the country. The outlook. The overall medium-term outlook for the global economy remains mixed, with indications of continuous softening of global output due to persistent policy uncertainties and sustained macroeconomic vulnerabilities. These are likely to be accentuated by the increasing trade tensions between the US and its major trading partners, rising debt levels, and geopolitical tensions. On the domestic economy, output growth in 2019 is expected to remain weak, peaking at 2.27%, while inflation is projected at 11.37% by the CBN staff projections by the end of 2019. The underlying arguments in favor of these projections include favorable oil prices, stable exchange rate, moderate inflationary pressures, enhanced flow of credit to the private sector, sustained CBN interventions in the real sector, effective implementation of the economic recovery and growth plan, building fiscal buffers, and improved security in the food producing areas of the country. Committee's consideration. In its considerations, committee noted the need to boost output growth through sustained increase in consumer credit, mortgage loans, and granting of loans to our small and medium enterprise companies. It also observed that the management of the bank had begun the prescription of using benchmark loan to deposit ratios to redirect banks to focus on lending. To mitigate credit risks, the committee enjoined the management of the bank to de-risk the financial markets via the development of a reliable credit scoring system similar to what applies in the advanced countries, as this will encourage deposit money banks to safely grow their credit portfolios. The MPC called on the fiscal authorities to expedite action on expanding the tax base of the economy to improve government revenue and stem the growth in public borrowing. It further urged the fiscal authorities to build fiscal buffers to avert macroeconomic downturn in the event of a decline in oil prices. The committee also called on the bank to intensify efforts to encourage Nigerians in their diaspora to use official sources for home remittances, noting that the effort will complement other measures geared towards improving the current account balance of the nation. It enjoined the bank to consider introducing incentives such as the reduction of charges on diaspora home remittances into Nigeria. On the African Continental Free Trade Agreement (AfCFTA), the committee urged the federal government to put in place measures to aid the economy in realizing the benefits and full potentials of that agreement. In particular, it noted the need to resuscitate moribund industries in Nigeria and improve key infrastructure in order to strengthen the productive base of the economy, create jobs, opportunities, as well as boost exports. The committee noted the positive developments towards the creation of a common currency in the West African zone by January 2020 and commended the government and the central bank for pushing forward the initiative. The committee, however, enjoined the bank to ensure that Nigeria is properly positioned to maximize the benefits of monetary integration. In consideration of the specific policy options to adopt, whether to hold or loosen or tighten, the Monetary Policy Committee made the following observations. 1. That while the focus on growth was imperative, the mandate of price stability remains sacrosanct. 2. Given the happenings in the external sector and the fact that inflation is moderating, tightening of monetary policy should not be an option at this time, as restriction of the capacity of deposit money banks to create money could curtail their credit creation capabilities. On the contrary, Monetary Policy Committee was of the view that while loosening could increase money supply, stimulate aggregate demand, and strengthen domestic production, the economy could be awash with excess liquidity, especially if loosening drives growth in consumer credit without commensurate adjustment in aggregate output. On holding the current monetary policy position, the Monetary Policy Committee observed that given the recent actions of the bank's management involving the prescription of minimum lending threshold to the deposit money banks, it is safe to assume that this action, targeted at stimulating credit growth to the real sector, will increase credit delivery to the real sector and accelerate investment and economic growth. It also observed that since interest rates were currently trending downwards, it is safer to await the full impact of these policy actions on the economy before a review of the position of monetary policy. The committee's consideration. In consideration of the foregoing, the committee decided unanimously by a vote of all members present to retain monetary policy rate at 13.5% and hold all other policy parameters constant. Decision was informed by the conviction of members that key macroeconomic indicators are trending in the right direction, and because of the lag in the effect of policy actions on output. Consequently, the MPC unanimously voted 1. Retain MPR at 13.5%, 2. Retain the asymmetric corridor at plus 200 and minus 500 basis points around the MPR, 3. Retain the CRR at 22.5%, and 4. Retain the liquidity ratio at 30%. I thank you all for listening.
Good afternoon, Mr. Governor. Please, I'd like you to use this forum to clarify a lot of issues that have been in the news. There have been reports quoting you about signaling the possibility of restricting FX for the importation of milk. That is one. And the second one I'd like you to address is that last weekend there were stories that the CBN restricted banks from the treasury bills markets. There have also been some clarifications somewhat, but I would still like you to speak on it because there's been some kind of anxiety that the CBN will just wake up one day and mandate the banks not to access that market again. Thank you.
Thank you. Okay. Good afternoon. My name is Gabriel Kuma. I report for Independent Television. Governor, please, I want to know, you said the core inflation as of June was at 8.8%. The CPI was at 11.22%. Now, if we have this for a long period of time, are we likely to see a 50 basis point reduction in the MPR to around 13%? And then secondly, I would also like to know how do you intend to get banks to do more of CRR-based lending, to access the over 4 trillion naira and boost the, $23 billion diaspora remittance and return Nigerians?
Thank you very much. Nancy, you raised two very strategic ones, but one very personal to you on milk. My mother fed me with milk. And Nancy, I think that boy should get more milk from you rather than the milk from the cows, but it's fine. Now, the issue is this. First, yes, there are reports the reports either quoting me or quoting somebody in central bank saying that there are attempts to restrict FX on the importation of milk into the country is correct. It's very correct because we believe that milk is one of those products that can be produced in Nigeria today. And you all must have heard me at different fora ask questions that we have seen the importation of milk in Nigeria before many of us were born, precisely over 60 years. West African milk, Friesland Campina, that I know as the foremost importer of milk into Nigeria, has been doing it by over 60 years. If you Google West African milk or Friesland Campina today, even on the website, they say that they have been importing milk or they have been in Nigeria for over 60 years. For over 60 years, Nigeria has been importing milk. Today, the import of milk annually stands at between $1.2 to $1.5 billion. That is a very high import product into the country. Given that it is a product that we are convinced can be produced in the country and let's ask ourselves the question, what really does it take to produce milk? Get a cow and give the cow plenty of water to drink and let the cow eat a lot of grass, and the cow positioned in a place without roaming around, that cow gets fat and you can take milk out of it. The reason some say our cows are not producing much milk is because our cows roam around, they don't have water to drink. Under the pastoralist arrangement, you find that during rainy season they are somewhere. When the rainy season recedes and the dry or hot season comes, they begin to move from where they are. And then as they move, just like they are cows and they are not human beings, they consume whatever they find on their way. But unfortunately in that process, they create destruction to farm products and farm produce in the country. About 3.5 years ago, when the policy on the restriction of FX started, we considered including milk in the list of items that should be restricted from forex. But we conjectured that based on the kind of sentiments that people like Nancy will show, that we should be very careful. We called in the management of the oldest milk importing company into Nigeria, WAMCO, into Central Bank in Lagos. We held at least 3 meetings with them. The IMD came with one of their ladies, and we held those meetings. We told them this would have happened, but that we decided not to allow it happen, but that we were trying to use the opportunity to appeal to them to backward integrate. Integrate backwards and begin a process of development and producing your milk in Nigeria. There are obviously 2 schemes. Either the West African milk or the milk importers acquire land and begin to graze their own cows and then fatten them and take the milk. And then, of course, they can also be complemented by the pastoralists who own their own smallholder, under a smallholder farming livestock farming arrangement. They can also get milk from them. Indeed, they could also be seen to be supporting the pastoralists, get them concentrated in a place rather than moving around, provide them facilities like water or hospitals or schools. I mean, if you are in a community, you want to enjoy the process of that community, there's nothing wrong in providing certain facilities to make those communities to blossom. Provide them with grass, even if you sell the grass to them. And the proceeds of what you get in return will be your milk to recoup your investment. Those are the kind of things that we expect companies that are importing milk into Nigeria to do. Unfortunately, after 3 years, or after 3.5 years, nothing has happened. Some of them said they started the pastoralist arrangement and all that, where they go and collect milk. And I was also in a meeting 3 weeks ago. After 3.5 years, after 3 weeks ago, we called a meeting again in MPC again in Lagos, and I said, we need to take stock of what you guys are doing, because we can no longer continue to spend close to $1.2 to $1.5 billion importing milk into the country, an item that we can produce. And to some extent, you should help us also to reduce the rate of the header-farmer conflict. Perhaps if you had started this journey about 3 to 3.5 years ago with us, by now, perhaps the headers and farmers conflict that we see today in Nigeria will not have been as intense as it is at this time. We would need your help at this time, because we can no longer wait for you to continue to be importing this product into Nigeria, because we are convinced it can be produced in Nigeria. That's our story. But of course, before we knew it, of course, I hinted at that meeting, which was the last meeting in Lagos last week Friday, that we were not going to continue to allow this process to continue, where they prefer to import the milk into country rather than doing backward integration. Of course, certainly what you would expect is that they went under the association and went to Manufacturers Association and Lagos Chamber of Commerce and began to lobby. And I had heard even Muda Yusuf also commenting about milk importation. I keep saying this: Nigeria belongs to us. When we have a policy, we want people to respect the policy of this country. We are saying that how much we spend importing milk is too high. We need to reduce it. We are saying that by doing backward integration, it helps to limit or reduce the rate of herders and farmers conflict in Nigeria. And we are determined to make milk production in Nigeria a viable economic proposition. And we will need to support them. We are saying, if we restrict it, or by the time we do so, if you need a loan to acquire land, we will give you loan. If you need a loan to do your artificial insemination of the cows, or you need a loan to grow your grass, in fact, you need a loan to even produce water, we will give you loan. But that you will continue to import milk into the country, I think we are getting to the end of the road. And that's basically what we discussed. And I will say, and I repeat, we are really, really getting to the end of the road. And the era of restriction of foreign exchange for the importation of milk is really coming, and will come very, very soon, and sooner than they expected. Because, I repeat lastly, at that meeting, West African Milk came and accepted that they will join this initiative for dairy milk production, not just dairy milk produced by the company, but also to support the activities of the pastoralists. And after a week again, we called another meeting. West African Milk has changed its position, because they had spoken to their bosses and their principals, wherever they are. And those ones told them, we will not change policy. If they will not change their policy, we will not change our policy. We want people to produce milk in Nigeria. That is our position on that. Nancy, you also asked a question regarding the restriction of deposit money banks on treasury bills and open market operation instruments. You will recall that at the last Monetary Policy Committee meeting in May 2019, the Monetary Policy Committee mandated management that, given that we observed at the meeting that there was a flat position in lending by the deposit money banks to the industry, that there was a need for management to look into how the banks can be refocused to do more of lending to the private sector, so as to grow the economy. Like you all know, the only set of institutions or persons by law that can conduct financial intermediation from a surplus sector to a deficit sector are banks. If they cannot provide that responsibility, then we have a problem. We would love to see the banks as financial intermediators to play this role, because that is one way they can be seen from the monetary policy side to be seen to catalyze growth in the Nigerian economy. And in an attempt to do that, 2 weeks ago we released a guideline that prescribes the minimum lending ratio for banks, because we said we will no longer allow a situation where when banks collect deposits from customers, all they do is just bring the money to the central bank or to government to invest in instruments. And after investing in instruments, after 90 days, 180 days, 1 year, they come to central bank, we cut them a check, and they put it as income into their balance sheet, and then they declare billions of naira. I'm a banker myself. No, that is not what it is. Part of their roles, but a core role that is required and desired of the banks today is that they should act as financial intermediators to provide credit to the private sector of the economy. And in that guideline, we said we will give them certain carrots or incentives that when they lend to the consumer credits, to mortgage credits, to the SMEs, that will grant them certain dispensations that they will be happy about. But that if they do not do it, then we will apply certain sanctions that will lead to taking those 50%, at least 50% of the unlent portion of their loans into the CRR. The deadline is 30th of September. And after 30th of September, we are going to begin a month-by-month monitoring and then prescription of deposit loan ratio for the banks, loan deposit ratio to the banks. It is because we all must work together as Nigerians to do everything that is possible to grow this economy. And the central bank, in conjunction with the deposit money banks, who are at the monetary side of policy in this country, must be seen to play this role. If we don't play this role, then we have failed in our responsibility. That is the reason. So what did we do? In an attempt to see that, yes, that we sort of begin to make them understand that we're serious, last week we did an auction. 2 reasons. One, signal that yes, we're still on a tightening mode because we're not going to go with the fiscal in terms of trending so aggressively downwards in rate. So we signaled close to about 12.25 to about 12.5% in the rate in the market, but also insisted that we do not want proprietary auction by the banks, in which case it should only be auction demand from their customers, either local or foreign investors. Just that they must know that that is where we want them to invest the money. We don't want them to invest their money in treasury bills. It does not, let me repeat myself, it does not mean that the banks are bad. It was meant to be a special auction, and I'm sure general auctions will continue. But at some point, from time to time, we can introduce special auctions to provide certain signals and really redirect the focus of actors in the money market or financial market about where we want them to go. That is it. So the story that maybe there are plans to bar banks from investing treasury bills and OMO is wrong. We would, but we need everybody's support to work with us in this attempt to achieve growth in Nigeria. And it is important that we say this, that when the Monetary Policy Committee looked at raised the concern that we had a flat loan deposit ratio. Then when we computed it was just about 57%. Whereas in other climes, loan deposit ratio in some cases is even more than 100%. I'll give you an example. In Brazil, loan deposit ratio as of today is 70%. United States 75%. China 71.2%. India 75%, South Africa 91%, Kenya 76%, Japan over 70%. Nigeria 57% is too low, and we need to get the banks to play their role of financial intermediation, and hence the reason we will continue to prescribe these ratios so banks know our direction on this policy. Gabriel on television station talked about the inflation rate at 11.22, and that when we're going to see a further reduction in the MPR. Like we said, that we would like to see inflation trend into single-digit territory. That the central bank itself has set an inflation target of between 6 and 9%. Between 6 and 9%. And because we are still above that threshold, we will only cautiously either do some true signaling, but we are not going to be in a hurry to moderate or to bring down MPR to the kind of levels that you are anticipating. But however, we're saying that without necessarily altering or adjusting the MPR, that we can take other measures, like the measure that we adopted now about prescribing minimum loan deposit ratio to the banks. That would help in a drive to increase the loans deposits. And indeed, because banks themselves know that if they do not do what we want, like we raised in the guideline, we will take the money that they have, we'll collect them and put them in CRR. And because they know that is a big challenge for them, that is why the rates are beginning to trend. In fact, there's price war going on now. So if you're a bank customer, you borrow. If Bank A comes to you, you need to begin to price your loans, because they will certainly come down, which is the direction that we want on lending in Nigeria. How do you intend to get banks to lend? To DCRR? Oh yes, we said so, but the point is this: it's important for us to know that the DCRR facility is a facility that we are offering as our own intervention facility. When you release money from the CRR to fund those interventions, it is also sort of a policy that blunts the efficacy of tightening policy. And we have said that those who will benefit from the DCRR funding will be those who are truly into core agriculture and importing plants and machinery to expand their manufacturing capacities. We would only continue to say that if you are into core agriculture or you want to expand your plants and machinery, of course, if you approach your banks, we do expect that they would present your facility to us for us to approve and disburse the money. Diaspora funds, there have always been issues about whether truly it's 21 billion or 23 billion, but our numbers don't say so, and we have asked our guys to conduct some research to find out how we can really track those funds and begin to say that these people, whatever incentive that they need for them to be attracted into the official or formal window, that we will do so. I thank you all for listening.
Thank you, Governor. And that was it. Simple, unanimous, and clear.
Well, answer, Governor.
It remains for me to thank all of you for coming and to say we see you again in September. Bye-bye.